I have in my practice lab where I haven't started Michigan. So when you're doing a return, you've made all the entries on the federal side, and then you're going to say that you want to start a state return. It's going to look, can people see my screen? Okay.
Yep.
Okay, we're going to do the state section now. We're going to add a state return. That's what it's going to look like. And it's a little different than last year. You're going to just click on Michigan, or you can go to the drop-down menu, but I'll click on Michigan. And in most cases, people will be a full year resident. We will have instances of part year residency. Most of the time, it's a full year resident. And I just want to give you kind of a look before we go into the slides. And this is what the opening menu looks like. Now, we're going to always go into basic information. I'm just going to click on that and tell you why that's important. You're going to pick your school district right here. Now, sometimes TaxSlayer asks for it on the federal side, and then it will be pre-filled. It just depends. And then there's a very important question right here that we often miss, and it is the taxpayer or taxpayers qualified for a special exemption? They get a bigger exemption. And on the federal side, they in the basic information section, in that drop-down menu, after you enter the primary taxpayer's name, social security number, and address, and so on, they don't ask if you're disabled. Only the children do they ask if they're disabled. So it's important that if we know the taxpayer or spouse are disabled, that we enter it here, because it does increase the exemption. Now, on the children, it also asks for other dependents that might have a special exemption. If those are entered on the federal side, they do flow through, but we, in our instruction, we like you to score it here as well. Go ahead. Any questions along the way are perfectly fine.
Sure. Sorry. Even if they are retired, will they be considered like disabled?
Well, when we go through the slides, if you're 66 or older, you can't be totally and permanently disabled, but you can be blind or deaf or hemiplegic or paraplegic, but you can't be totally and permanently disabled once you're 66, and that'll be in the slide material.
Perfect. Thank you.
All right. Okay, so let's come back out to that opening menu again. There we go. The next area that we go into quite a bit are subtractions from income. And we go into this area primarily for special treatment of retirement benefits. I'll click on that. And this is something that's true throughout TaxSlayer. Always be aware that you have to scroll all the way to the bottom on a lot of the screens on your computers, because you're not getting the full picture most of the time. And in this case, it's especially a problem because the most important area is this area right here. Deductions for taxpayers born before 1953. And that's where we're going to put the retirement information that's relevant. Now, this is very bad nomenclature right here, because you could be born in 1960 and get a benefit in this area if you have Social Security exempt retirement. And I hate even spending any time on it, because I think we had 2 or 3 returns last year where there was Social Security exempt retirement income. We don't see it a lot. But I'm going to click on that just to show you that, again, this is a little bit strange with TaxSlayer software. You can see the very first thing is do you have retirement benefits that are exempt from Michigan income tax with a begin? But if there is Social Security exempt income, you're going to have to answer these questions down here and then go to the begin. And Then a common error is the very first question. Do you have retirement benefits that are exempt from Michigan income? Let's say you're doing a return for someone that the primary taxpayer was born in 1945, so he's tier 1, and you know his retirement income, there'll be a benefit for that. You can fill out all the stuff down here perfectly, but if you don't answer this yes, it won't flow through to the return. So you always want to make sure that drop-down menu is a yes if you know it's a yes. There's another question on Social Security retirement income, if it's relevant. And then there's a deceased spouse thing that's new this year. So there are two ways that a deceased spouse can benefit a taxpayer. One is if you inherited a retirement income from your deceased spouse. That's one way. And the other is to accrue the filing benefit of the deceased spouse. So as an example, if a woman was born in 1948 and her husband died 3 years prior and she had not remarried, she could get the tier 1 benefit of her husband accruing to her as long as she had not remarried. And this is a new thing this year, this question right here. And then you're going to go in, and in the retirement benefits, you're going to score them in here, and they're all going to be flow through from what you entered on the federal side. And you're going to answer you're going to click on however many 1099-Rs there were. They'll be preloaded, and just say whether they're private or public, because they get treated differently for tier 1, and that'll be in the slide material. So it's just kind of a quick what happens when you go into that particular deductions for taxpayers born before 1953. Then this is a big area that we almost always go into, and it's called credits. And that's where the homestead property tax credit and home heating credit are. Just going to click on it real quick. And those two credits are the first item on here. You're going to click begin. And this is another example about scrolling down to the bottom so you don't miss something important. In the slide material, those of you that have been here before know all about this. There's a concept called total household resources. And this is where you're going to make the additional augmenting entries for total household resources. A lot of the entries that were already made on the federal side that are income related will already flow into the form, but there are many examples of additional entries that you'll have to make, and they all happen here. And a very important one is all the way down to the bottom. Again, got to always scroll down to the bottom, and that's you get a reduction in total household resources for the amount of medical insurance that you pay. And a portion of a person's automobile insurance is medical insurance. And we'll cover that in the slides. But it's easy to miss that. And it's on the opening page here. And then you just go into these two credits, and they're going to ask, the very first question is are you eligible? We're going to have several slides on what makes you eligible for the homestead property and home heating credits. You'll just have to know that. So it's a yes, no right here in this drop-down menu. And then are you a homeowner or renter? You'll know that from the material that is provided by the client. And then you go into these sections down here, but again, TaxSlayer doesn't do a really great job of labeling. So if you say that you're a renter up here, you can go into two different parts, part 2 or part 3. Part 2 should read, complete if you are a renter in a full property tax paying facility. That's what it should say. Because part 3, you're also a renter, and there's several things in part 3. So part 2 is like for people that are full property tax paying renters, and also people in trailer parks where they're paying full rent. It's full property taxes. We'll go through that in the slides. In this part 3 area, there's a whole bunch of stuff in here. There's service fee housing, which we'll cover. There's subsidized housing. There's cooperative housing, home for the aged, nursing home, adult foster care. And then if you paid room and board. Now, one of the challenges of getting the homestead property tax credit right is there are instances where you're going to enter the property tax as it actually is if they're a homeowner, or you're going to enter the property tax for cooperative housing based on a calculation, or in a nursing home, it's like whatever the percent of the total nursing home property tax there was, how much was the client's. There are instances where you're going to enter monthly rent times the number of months rented. That's in the renter section in part 2. And there are instances where you're going to enter annual rent, and that's for subsidized and service fee housing. Not monthly rent, but annual rent. And about 3 years ago, 2-3 years ago, we had, 3 returns that got filed where the preparer got confused, the quality review person missed it, and we filed returns where the total rent was $130,000 because we entered the monthly rent as the annual rent, and it got multiplied by 12, and we got into a little bit of a mess. But we didn't have any of those last year because we really look for that. Let me come back out now, and there's just one last thing I'll touch on before we jump into the slides, and that's the use tax. 99.9% of our clients will say they don't have any use tax, and we'll explain what that is again to you. I think most of you are familiar with it. Now I'm going to stop share, and I'm going to reshare, and I'm going to go to my Acrobat Reader. And I just want to talk about a couple of forms. Since we just talked about the homestead property tax credit, I just want to show you that, it's a 3-page form. And in the slide material, we're going to go through tax law first. How does it work in tax layer? And where does it end up on the form? And I think it really paid off last year with our training, because you have to learn to see where did all this stuff go, and is it in the right spot, and does it look reasonable on the forms? So this is the property tax credit form, and this is like name and address and stuff and filing status and so on. But right up in here in this page 1 is where a lot of if they're a homeowner, what the taxable value is and what the property taxes are. This is where the cooperative housing amount, or if it's a nursing home amount, will flow to. Renters, the rental total rent will go here, and then 23% of the rent is assumed to be property tax. And then that'll generate a property tax estimate here. Total household resources, on the page in the software that I showed you, those supplemental entries will flow in here, as well as entries that you already made that were income related on the federal side. They'll just automatically flow in. Importantly, in Social Security, the number that will be in here will be net of Medicare payments. So you don't ever want to double count Medicare payments for when you added that medical insurance amount that was on that software opening slide. Now, page 2 is where the calculation is done. And one thing I like to so you get a feel for things. So the bigger your total household resources are, the smaller your homestead property tax credit will be. So the way it works is when you get to your total household resources, there's a computation of 3.2% right here on line 34. You take 3.2% of the total household resources, and the property taxes actual or imputed have to be greater than that for you to continue on to make some calculations. And then there are special benefits. There's a whole bunch of them. If you're a senior, it's just automatically done by the software. If you're disabled, there's a benefit. If you're extremely low income, there's a benefit. If your THR gets above 50,000, they start to phase out the property tax credit. So there's all kinds of side tables and calculations, but the software doesn't. And then on the third page is where all of the actual record of, well, where did this person live? Were they a homeowner? Did they move? That's on the top of page 3. Renters, what was the name and address of the place you rented? What was the landlord's name? Number of months rented. If it was more than one place, there's 2 spots. And the rent paid, and this flows to page 1, and 23% of that is assumed to be property tax. And then all the alternate housing facilities are here. Subsidized housing, service fee, special housing, including cooperative housing, and all the other ones are right here. So that's that form that we're going to see. You'll learn to read that form. This is the Michigan 1040. The top is pretty much all the same stuff, except in Michigan, there's only 3 filing statuses. I'll cover that in the slides. This is where the exemptions are generated, including the special exemptions. And all these went up. We'll be covering that in the slides. And that exemption amount flows down to line 15 as a reduction on taxable income. But the way Michigan taxes work is it starts with the federal adjusted gross income. So whatever that AGI is on page 1 of the 1040 just comes right into the Michigan return, and that's sort of the starting point. And there can be additions to the AGI, and there can be subtractions. And most of our clients will have subtractions, and they'll come from Schedule 1. For example, if any Social Security was taxable on the federal side, software will automatically make that a subtraction. If you make entries for retirement subtractions, they'll flow through to Schedule 1 as a subtraction here as well. And then you'll have a taxable income. Importantly, on page 2, the property taxes on line 25, you'll learn to find that right away. How much property tax did it generate? The max is $1,500. The earned income tax credit from the federal side, if there is one, will automatically flow through, and Michigan gives 6% of whatever the federal earned income tax credit is. And then there's withholding here and so on. And it comes down to either a refund or amount owed. So just a quick look at a couple of the key forms. I'm now going to go into the slides. There it is right there. And I need to get this out of the way so I can do the, why can't I get rid of that thing up there at the top? Won't even let me, oh, there it goes. Okay, I want to do slideshow, play from the start, and I'll go through this and interrupt anytime, doesn't bother me.
You can also you can drop questions in the chat as well.
Or I'll be, Patrick, if you could look on the chat, because I got it on my full screen.
Yeah, so just whatever works for if you have
Right.
any questions or input.
So as I said, we're going to cover, I kind of touched on every one of these topics right here already. And we do have a really good quiz with answers that actually came from the state that are in a state document that we'll tell you about at the end. There were increases and a bunch of things got inflation adjusted. I'm not going to go through every one of them, but I'm quite impressed with how much the state increased exemption amounts. Pretty good inflation adjustment there. There's a really weird thing that happened. Used to be that Tier 2 was born 1946 through the end of 1952. They added a special category for people born in 1953. I call it Tier 2.5. And we'll tell you about that. You don't even have to do anything, though. I have beta tested TaxSlayer software, and it automatically figures this out. We'll cover that in a slide. Basically, they don't get as much as somebody that was born in 1952 as a standard deduction. It gets reduced depending on a couple of circumstances. This is that surviving spouse, not remarried, born after 1945 benefit. We'll take you through that. Again, I find this interesting. Tier 1 had the inflation adjustments everywhere. Tier 2 did not. Tier 3 doesn't get anything anyway. I don't know. There must be a lot of Tier 1 politicians in Lansing. That's all I can figure. The home heating credit, standard allowance, and alternate allowance got inflation adjusted slightly. And this is really important. The payments, stimulus payments, economic impact payments, whatever you want to call them, are not to be included in anything, not in income, nor are they to be included in total household resources. The check protection payments, though, are included in THR, but we're not going to see any with our clients. Now, this is an issue. You know, the unemployment benefits were, in many cases, more than the people were making when they were working during the pandemic in 2020. And there's been a lot written about this, that not enough withholding was taking place. So we'll just see what happens. This came up today in this conference call I was on with all the other sites in Michigan, that there's a lot of concern about this. We'll just see what happens. There's not much we can do about it. It is what it is. So, oh, by the way, the Michigan 4012 should be coming out any day. That's what I learned today. And the Accounting Aid Society slides are going to probably be the end of the month. A lot of the slides that are in here are Accounting Aid slides from last year. So as I said, it'll be an explanation of the tax law. We'll look at how you make the entries in tax layer, and then we'll flow, how do things flow to the forms will be the format that we're going to go through. I've already talked about exemptions. They come from the federal return entries that you make. And they affect your Michigan income tax as well as the home heating credit, the number of dependents that you have. Special exemption are for deaf, blind, so on and so forth. In most cases for us, it's totally and permanently disabled, or TPD, we often call it. And that, if the person is TPD or any of these things, it certainly helps your income tax because you get an extra exemption, but it also helps the homestead property tax credit. So, you know, when do you even have to worry about filing a Michigan income tax? Well, you know, the Michigan income taxes kick in a lot faster than they do on the federal side. Even though the feds don't have a dependent deduction anymore per se. They have a very large standard deduction, as you know. But in most cases, our clients will want to file a Michigan return because they're eligible for the credits, even if they're in, you know, especially if their income is especially low. So, you know, we find that we're filing for just about every Michigan person that comes in. But if they had any withholding, they want to get that back. If they had an earned income credit, they want to file for that. And then the 2 credits is what will drive them to want to file. There are only 3 statuses in Michigan. We talked about that. Let's see if I can move this thing out of the way. I got something blocking me a little bit here. I'm trying to slide it up. There it goes. So I think you guys are aware that Michigan only has those 3 filing statuses. So if you're head of household, you're single in Michigan is the big one. And then if you're doing married filing separately federally, you have to do the same in Michigan. And all that will be handled automatically by the software. You don't have to make any decisions or go to a decision tree or anything like that.
Bob?
Yeah.
Married filing separately, there is a special requirement on the total household resource page. To fill
Yes,
out
there
a
is.
form.
Yep. Well, we'll just show where that is, Scott. We're not going to teach it today. But if you have a married filing separately, you know, you're going to have to do some work, and it's laid out pretty well in the Michigan instruction book as well as the Michigan 4012.
Rare occurrence.
Yeah, it is rare, but when you get one, it's kind of a pain. So starting in tax year 2018, you know, the feds did drop their dependent and personal exemption to 0, but Michigan, you know, kept it, and they keep inflation adjusting it, as we pointed out. This is a slide that I added this year to point out that for a lot of our clients, single ones and married filing jointly with no kids, this is like how much taxable income do you have to have, and when you start paying taxes. You can see on the federal side, you can have a lot more income before you start paying income taxes. But in Michigan, it kicks in much lower. Now, if there are kids in the family, it's actually a little bit closer. And then head of household, it's a little bit closer too. But a lot of our clients are in this area, and it's always surprising them. Geez, I got to pay income tax. You know, we have a very regressive state tax system where kicks in at a much lower income level than it does on the federal side. Already covered that. Really. Totally and permanently disabled, there's some words here. We're gonna have other ways to know. I mean, it isn't gonna, especially with a virtual tax environment, we're not gonna know. But there are other ways that we know. They can indicate it on the 13614C. It's on page 1 for the taxpayer and spouse. If they're under age 62 and receiving Social Security, that's a real indicator that they're probably disabled. And if you ask them, they'll know. But they can be getting Social Security and be less than 62. For example, a non-disabled widow or widower. And if they're under age 65 and receiving supplemental security income, those are indicators. You can look at the prior year tax return to see if they were scored as disabled. If they're under 62 and living in subsidized housing, you should ask. I'm not going to cover these. They're pretty straightforward. We don't see it a lot. Remember, you always should go to the basic section. Always. In the beginning of our evening, I pointed that out. That's what it looks like in the opening page of the Michigan software. You put the school district in, you answer these questions, and if they apply in the return. So it's important we get it right. Now, we already went through the 1040. This is where the exemptions are, subtractions, and so on. I don't want to spend time on it now. AGI transfers over directly. I'll just make one point about AGI. So we know that this year with the CARES Act, you get to deduct $300 of charitable cash contributions on the federal return. That's also going to save money on the state return because it's going to reduce AGI. In education credits, we have 3 possibilities. We have the American Opportunity Credit, the Lifetime Learning Credit, and the Tuition and Fee Credit. And depending on circumstances, sometimes the tuition and fee credit is the best deal for the taxpayer because it's a reduction in AGI. So just keep that in mind. And we actually did, I think Emma sent it out. I did a write-up on this. Which one do you pick under what circumstances? Because you remember the lifetime learning credit is a refundable credit, a non-refundable credit, I mean. So if you don't have any taxable income on the federal side, the lifetime learning credit doesn't do anything for you. But the tuition and fee credit would because it flows through to Michigan. So the tax rate's been 4.25% for a long time, and it's a flat tax, no matter how much income you have, unlike the federal system, which uses a progressive tax bracket system. So now we're going to get into retirement benefits. So you might want to have a sip of coffee or whatever wine you're drinking. So Tier 1, very generous pension deductions and inflation adjusted again. Tier 2 is an automatic standard deduction of 20,000 single, 40,000 married filing jointly. If pension benefits are taken out of your income, there's a form 4884 that has to generate. We'll cover that in a minute. This is the new thing in this tax year. If you were born in 1953, I can't read it because this thing is in the way. Let me just look at this here. So this is right out of the Michigan supplement. You can deduct the personal exemption amount and taxable Social Security benefits, military compensation, and Michigan National Guard, and railroad, et cetera. Or you can deduct 20,000 single, 40,000 married filing jointly against all income. So you have a choice, but you don't have to worry about it, frankly. As I said, I have really done a lot of testing of this In TaxSlayer, it does it automatically because you've entered the birth date on the federal side. So it knows that one of the taxpayers is in this category, either the primary or, whatever is going to give you the biggest benefit. It also knows how much of the Social Security was taxed on the federal side. And it knows what the exemption amount is. So it just automatically generates the deduction. And there will be a worksheet. So when you do a return where somebody was born in 1953, this will actually be in the printout. And here's an example. This is a single taxpayer who was born in 1953. And in the worksheet, you'd enter 20,000 because he's single. The software does it. His taxable Social Security benefits on the federal side were 3,000. That's what they asked for in line 3. Then you enter his exemption was 4,750. You add those two together, that's 7,750, and you subtract that from the 20,000, and that's his standard deduction. So for a single person who's not disabled and their exemption is 4,750, the maximum the person's going to get is 15,250, which is the difference between 20,000 and 4,750. So basically, they kind of smoothed the transition from tier 2 to tier 3 with this tier 2.5, I call it. Question.
Bob, I just have not a question, but if you have our faces blocking you in the way, you should be able to.
I know. I can slide it right out of the way. You're
Oh,
right.
perfect.
I will.
Just checking.
I have a
I'll get it
question,
out of there. I don't know why I don't do that.
Bob. For people born in 1953, aren't their Social Security benefits never taxable? So wouldn't they get the 3,000 in addition
Yeah.
to the 20,000?
Yeah. No, they don't. No,
I thought Social Security was never taxable in Michigan.
it isn't. But they so you got it. You got it through this mechanism.
But wouldn't it
So
be?
they're not going to double count a subtraction. So if you go in, I'd have to find it, Martha, and I'll show you a return where I did this in TaxSlayer Practice Lab.
Mhm. But
And I'm quite sure that's the case.
But this single person would get 20,000, but then they also, in addition, would not be taxed on their Social Security because Michigan never taxes Social Security, right?
It's on a different line. It's going to come across on a different line on the form, the subtraction, I think, for the taxable Social Security.
So let's put that in the parking lot because I'm going to go in and pull that return out of the practice lab and take a look, and then I'll send you some snapshots.
Okay.
It is true, Social Security is never taxed. But I believe it's not taxed here either because
It would be.
no, you're right. It is. It's going to still show as a subtraction, that 3,000. They use this to drive down the standard deduction, which is what they should have done.
Hmm.
So it's not a double count. I'm wrong. It will show up as a subtraction in the additions and subtractions form. And then this will be on the bottom of the additions and subtractions. And I'll show you that later on when we get to that schedule. This is the surviving spouse words right out of the Michigan Department of Treasury about that special consideration for a surviving spouse who was born after 1945, not remarried, and claimed a subtraction for retirement and benefits on a jointly filed return on the year the descendant died. Decedent. How do you say that? Decedent. Decedent. That's it. Okay. And you get to pick the larger of the two, So here's a form 4884, which is where pension deductions are summarized. What's circled in red there is this new surviving spouse checkbox if all the conditions are met. So Martha, I know you and Dennis have been working on the intake sheets for Michigan for our clients, or somehow we got to get that from them. But the 13614 asks if there's a deceased spouse, I think too, doesn't it? But it's an easy one to miss, and you know, it's costly if we miss it.
Right, there's a new checkbox this year that wasn't there last year that spells out those conditions, and it's very helpful in TaxSlayer.
Okay, yeah, it's in TaxSlayer. Yep. So again, as Martha said, these items here are never taxed. Military pensions, National Guard pensions, Social Security benefits, railroad retirement benefits. 99% of what we see are Social Security benefits. Anything that's taxable in AGI is automatically subtracted in Schedule 1. Qualified pension and retirement benefit distributions eligible for subtraction do get reported on Form 4884. Almost all of our 1099-Rs will have a 7 in box 7. Here's a list of, well, how do you know if it's qualified? And I'm not going to read through it. Generally, most of the 1099-Rs that are Code 7 and even Code 4 are qualified. There are some things you got to watch out for, like, you know, one in particular is deferred compensation. We're not going to see that with our clients. It does exist out there quite extensively, but not in our client base. So, you know, the first step is, you know, is the person in the age where there might be a retirement benefit? What's the age of the oldest, if they're married filing jointly, or if it's single? What, you know, are they Tier 1, Tier 2, or Tier 3? And then you got to watch out for Social Security exempt retirement income, but it's rare. Sometimes I think we shouldn't even teach it, but you know, if it's there. And then we have to watch the 1953 special treatment is done automatically by the software. These are all the codes for 1099-Rs. So, you know, Code 3 also counts, disability counts. And Code 4 counts, Code 7 counts, and 5, 6, 8, and 9, you know, we're not even, it's out of scope. So this is what a 1099-R typically looks like. And then the distribution code in box 7 is kind of in the middle. Most of you that have been doing returns for a long time are very familiar with this form. So Tier 1 is a little bit repetitive. You know, the reason when you go into the software, they ask if it's public or private for a Tier 1 person is the public pension limit is it's unlimited. The dollar limit in Tier 1 is for private pensions. So, you know, where are you going to see public pensions? Where do they come from? It's mostly government workers, all the way down to local government. But public retirement benefits from out of state, we score as private. We see that once in a while, not very often. So 46 to 52 is a standard deduction, and Social Security still being exempt. And I'll tell you, we do get some sad instances. I've seen it quite a few times where a client comes in, he was born in 1945. He had no retirement income, no 1099-R, but he had $24,000 of wage income. He's working, you know, he's like whatever age he is, in his late 70s, I guess, if he was born in 1945. He gets no retirement benefit whatsoever. Now, if he were born in 1946, it would take $20,000 off his taxable income. But in 1945, the only benefit is retirement pension income, and interest, dividends, and capital gain income. So there's some holes and flaws in this Michigan tiering system, but there's not anything we can do about it. The SSA exempt amounts are even higher, and the ages go higher too, by the way, quite a bit higher. We don't see it very often. A lot of you last year would ask me, well, why are they so much higher? Well, they don't have Social Security exempt income because their retirement was presumably largely based on, being Social Security exempt. So that's why it looks like it's larger, because it's presumed they don't have Social Security benefits. It's just more on SSA exempt. You don't really have to do anything for someone born 1946 to 52. It's done automatically. And there's no 4484 because it's a standard deduction. So again, tier 3, this says born after 1952. It should say 53. I missed that because of the new change. And you have to watch out about the wording and tax layer. So the only people that are born after 1953 who are going to get standard deductions for retirement income are the SSA exempt people. That's pretty much a repeat. That's just a repeat on the amounts. So for all of those amounts get generated if you answer the questions in tax layer on SSA exempt as they come up. It will generate the correct standard deduction. Now, if there's a deceased spouse that was born in, prior to 1953, or, tier 1 or tier 2, there is a benefit, and you have to make entries about you saw that in the tax layer software. You have to know the Social Security number and the year of death. It's pretty redundant. So I guess to make sure you get this right is when you have especially a tier 1 client, either one of the, it's a married couple, either one being tier 1. It's your tier is based on the oldest of the two in a married situation. Then you have to start thinking, I got to get this right. Now, pension, interest, dividend, capital gain income will automatically flow through as a tier 1 deduction as well. It's where you go right here, subtractions from income in tax layer. You go to this area right here with the caveat that you got to be very, very careful about SSA exempt. There's 2 SSA exempt questions right here. And then you go back up and click begin. This is for tier 1 and SSA exempt filers only. You don't ever even go in here if the person's tier 2, if the situation is tier 2. There's a third SSA exempt question. And this is the deceased spouse information right here. And this is the question about the widower who never remarried, that Martha said was very clear. This is new this year, this question right here. And then when you're all done with all of this stuff up here, you must click begin. And when you do that, your 1099 Rs will come down and you must complete this section. And it'll look like something like this. And when you click on each one of them, it'll say, in almost every case, it's just answering, is it public or private? And is it from a deceased spouse? In the vast, vast majority, it's just answering this question right here. This is that drop-down menu from the previous slide that showed the 2 retirement pensions. And then when you're done, now a little bit, this is a good time to bring in navigating tax layer. When you're done getting like to the end of an area like this, you know, retirement benefits that are not taxed, you always go to the right lower corner and click whatever that is. In this case, it's save. You don't click back, you click save. And at the bottom of every page, it's different. You know, sometimes there's only one choice, sometimes there's 2. I believe, and some of the experienced preparers can confirm this with me, it's the one in the right corner, that's the one you should click. I think every time. This is form 4884 on the back page, where some of these subtractions go and where they show up. I'm not going to go through this in detail, but there's an A, B, C, and D section. If you read the Michigan instruction book, you just would be blown away. And if this is like the Schedule 1 that we're talking about, and if there's Social Security exempt retirement income, those questions that you answered in the software would populate in this area right here. If there's just a standard deduction and you didn't have to do form 4884, it'll show up right here. If you were born in 1953, it's going to show up right here, that deduction, like worksheet example I gave you. So this is a new line right here. And then the retirement benefits for tier 1 will show up on line 25. And then the capital gain and loss for tier 1 will show up here. So you got to learn to look for these things in the schedule just to make sure that everything flowed through. Any questions before I go to use tax?
I have one comment. Sometimes you get a pension that's below those personal exemption amounts. And so it's going to be, your AGI is below that amount because your Social Security is probably not taxed. So it comes across from federal AGI, say $3,000 from a pension. You don't even have to go into the pension schedule.
That's a good point. That's good. That's a great point, Scott. Yep.
The reason being that there's no tax to begin with.
Right. That's a good point. Anybody else? Okay, use tax. I don't want to spend a lot of time on this, but what use tax is, it's an attempt by the state of Michigan to collect sales tax that was not collected but consumed in the state of Michigan. So how does that happen? Well, it used to happen a lot when Amazon and other online retailers were not collecting sales tax. Now that's all stopped pretty much. I don't know of a website out there that's not collecting sales tax right now. But there are situations where they're still trying to collect it, like people will buy a lot of furniture from a state because they're refurbishing their home. That's not going to happen with our clients, but their sales tax in that state is 4%. Michigan will want you to, pay the extra 2% as part of your state return. Or if you went to Delaware and you bought a bunch of golf clothes, Delaware does not have a sales tax. And you bought a bunch of wine and you brought it back to Michigan to consume it here, they would want you to pay the full 6% on those purchases. So they have a formula that you can use, but we pretty much zero this out. It's rare that we'll have a client that will say, I didn't have anything like that. nothing. So in most cases, we zero it out. But the teaching in this class tonight is that you should ask, not just assume, but you should ask. Okay? And in Tax Slayer, it's in that opening page, use tax. I always go in and say, no, I'm not using the tax tables, and I put a couple zeros in. But if you don't, if you just leave this blank, it won't generate a use tax. So just to make sure I go in and make those entries. Okay, now what time is it here? Yeah, it's not too bad. We've only been at this less than an hour. Is it okay if I just keep on going?
I think the consensus is yes. So it's
Let's
safe.
go. So there are 3 refundable credits in Michigan. The earned income credit happens automatically, and then these 2, homestead property and home heating, take some work. Already covered that. But the 2 Michigan credits both rely on a concept called total household resources. This is a very Michigan specific term. We will have resources that are already, I think, on the United Way resource website on what's in and what's out. Many of you have been working with this for a long time, and you have a pretty good idea of what counts and what doesn't. So this will be a little bit of a refresher. So income for total household resources includes both taxable and some non-taxable income. So basically, federal adjusted gross income plus all specific Medicare payments goes into THR. So it's the reason they use the word household. The household is defined as a claimant and spouse. So it's both sets of income, which will typically be in the return anyway. So even if they don't reside together, you count both of their income. But child support is not taxed, but it would count as, would go into total household resources. Any workers' compensation not included on the federal side would go in. FIP or MDHHS benefits would go in, but food stamps do not go in. Supplemental security income goes in, and gifts or expenses paid on your behalf over $300. So this is a little bit redundant. This is the Accounting Aid Society slide. This is one that once in a while we see this. On the federal side, most of the time, the sale of a home that's appreciated is not going to be taxed as a capital gain, because it has to have a gain of greater than $250,000 as a single person and $500,000 married filing jointly. But in Michigan, they want you to count, let's say the gain was $40,000, somebody sold a home. They want that to go in THR. And this is the reason I have an arrow on non-taxable scholarships, because I always find this to be amazing. So as you know, on the federal side, when you're entering income, the way we've done it historically is if there was a 1098-T that had qualified expenses of $3,000 and scholarships of $6,000, that difference would be an AGI already. With the $3,000 that you offset on the federal side, you have to add as THR in total household resources. It isn't offset by qualified expenses. It's crazy. So, I think you know about supplemental security income. By the way, that's 2020, that's 783 on down there. And I do know the amount for married filing jointly too. I looked it up. So Julia and Patrick I'll send that to you guys. I looked it up today and we can fill out a table. Typically, they don't have a statement when they come in, have come into our clinics. Now it's going to be done virtually. But you'll say, well, was it $783 a month? They'll say, oh yeah, that's what it was. Yeah, that's it. And then you just multiply that by 12 if it was a full year thing. But a lot of times they know because they keep track too. But it's one of those things that, you know, there's no, like for Social Security, there's the SSA 1099. You know, you got a record, official tax document. They don't do official tax documents for SSI. And then there's the Michigan part, which is typically $42 a quarter. And this is not inflation adjusted. But they'll say, oh yeah, I get that $42 check every quarter. Then you add that as well. So a little bit of a difficult area is if children in the household are getting Social Security, you know, for either a disability or death of a parent or something. When do you count it in THR and when do you not? This has been a source of confusion over the last several years, but I think it's settled down to a way to handle it. If the checks are coming in the taxpayer or one of the taxpayers' names, you count it. If it's coming in the child's name, you ask the taxpayer how much of the Social Security payment is being used for household expenses. And they might come clean and say, yeah, I use 100% of it. My kid signs it over to me and I put it in the checking account. We use it to cover all our expenses. Well, then you include it all. Or they might say, you know, the child's 16, they'll say, no, I let my kid do whatever they want with that. They buy games, athletic equipment and whatever, that's their money. Then you don't count any of it. We've already covered that. So child assistance, you do count. Whether it's given to the caregiver or to the one of the taxpayer. Whoop. There it is. Got a jumpy. Capital gain or loss will carry forward. There's the point on the residence again. You have to include that gain in THR. Non-taxable scholarships, repeating. Now, I showed you where medical insurance premiums go in and what counts there. Well, certainly medical insurance payments, dental insurance, vision insurance, a prescription drug plan. A lot of our seniors have these things. And automobile insurance. And if they don't have their automobile policy, we assume $130 per insured vehicle. But do not include long-term disability insurance, long-term care insurance, or pre-tax payroll contributions for health insurance. And again, the point on the don't count the Medicare insurance that's deducted in the SSA 1099, that's netted already by the software in the Social Security entered in THR. It's netted out.
Hey, Bob.
Yeah.
Didn't they make some change to car insurance in Michigan this year where people might not have the medical portion anymore?
No, I think they'll still have the medical portion. I think that was more of a no fault thing.
Okay.
So you can, if you have Medicare, you can drop PIP, which was the medical portion. So some of our older clients may not have that as part of their car insurance anymore.
Yeah, if you have any health insurance that will cover you, you can drop your PIP now. That's the whole thing that happened.
No, that's interesting, Martha. That did not come up in that phone call today. And we talked a lot about this car insurance thing too. There's a site in Jackson that's instead of 130, they've been doing 108. They've been doing 180, and if they're on Medicare or Medicaid, they've been assuming 240. They've been doing it for 10 years and never had a rejection.
Well, it's really, for Medicare, it should be just reversed because
I know it.
Medicare people don't need PIP anymore.
Yeah, I know it. But generally speaking, for that deduction, it's better to have the insurance policy to make sure you're getting the maximum benefit.
They told us in AARP training today that you could use 130.
Yeah,
Yeah, but I don't think anybody understands it. I think Martha's right. I've read about this, but I think, Scott and Martha, I think we'll do a little bit of research because I think from what you said, Martha, and I've seen this, if they're on Medicare, we should assume zero.
well, they can opt to keep it. We could at least ask what they've done.
Well, I suppose, yeah.
My insurer was trying to talk me into keeping it, and I eventually dropped it on mine. But I think we can get away with 130 because no one, as you say, based on the Jackson example, nobody's looking anyway. But I think in time, we won't be able to do that or assume that there's medical coverage as part of auto insurance.
So, it's only worth at most 3.2% of the 130. So it's what is that? $4, $5, something. And depending on the circumstances, it could be less. So it's not a lot.
Right.
But for simplicity, maybe we just do the 130.
Person?
Yeah, for vehicle, per insured vehicle. For the medical insurance deduction. That's what we've been doing for years, if they didn't have the insurance policy itself.
Yeah.
So these are where, I'm not going to go through these in detail, but when you open up in TaxSlayer, the opening page to the two credits, remember I told you had to scroll down to make the additional supplemental income entries. They go on various lines. And this is kind of the guide to where they go. Now we're going to get into the credits. So sort of the foundation of the two credits is THR, and it's the foundation for both. So you can be, this is a long-standing problem. The term homestead, many people think you have to own a home, but renters and homeowners are both qualify. They each have their own criteria. And importantly, you can go back 4 years. This is the only place in federal and state taxes that you can go back 4 years. In most other places, it's 3. And for the home heating credit, you can't go back. But we've had, every year, we have examples of clients where we go back 4 years. We had a few last year again. So, the maximum total household resources is $60,000. Phase out begins when THR exceeds $51,000. The maximum credit is $1,500. It used to be for years it was $1,200, and I think it was 2 years ago it went up to $1,500. Also, at the same time, they increased the amount of rent that's used for the imputed property tax to 23%. It used to be 20%, so that got richer as well. But service fee housing is 10%. And co-op housing, when you look at it, it's almost always less than 23% when you get a co-op letter. And I have an example of one in here.
Yeah, Bob, we do have a question about, what if you buy a house and move from an apartment to a house? Is it okay if
you enter both places on the in the software? You'll go into the homeowner section and the renter section. Let's say you were in your rental property for 7 months of the year, you'll have 7 months of rent, And then for being a homeowner, you tell them, you go to the homeowner section and say, how many months did you own the home?
Great, thank you.
Yep. And I talked about that 3.2% threshold already. Now, as you may recall at the beginning of this teaching, when we went into the software, the first question is, are you eligible for the homestead property tax credit? So you have to know. So you got to be a resident of Michigan for at least 6 months. The individual was billed for property taxes or paid rent on a Michigan homestead. So, you know, it is property taxes billed, not paid. So if someone's in arrears on their property taxes, it doesn't matter. It's what were you billed? The individual must be an occupant as well as the owner or renter contracted to pay rent. So we always say, do you have a rental contract? Are you on the rental contract? Are you on the lease? If it's property, it must be subject to property tax or service fee in lieu of property tax. We do have some people who are in residences that pay no property taxes. If it is a homeowner, the taxable value has to be $135,000 or less. And THR again can't be over $60,000. So you got to know whether they're qualified before you answer yes. So most of you have enough experience that you know this right off the top of your head. Any people who cannot claim the credit if they're just on FIP assistance or other MDHS benefits, they are not qualified. Those with total household resources over 60 again, and then the taxable value over 135 or over. Now, blinded veterans can use a different form. It's a CR2. I don't think we had any last year that used this. You're supposed to use the form and pick whether the CR1 or CR2 is better. So, you know, and also for active military, if the THR is more than $7,500, you can't use it. So it's pretty low. Scott, I don't know if AARP ever uses CR2. Or Martha, you have experience over there too.
No, I've never used it.
Yeah, I know that Accounting Aid Society it's a very hard form to do, I can tell you that. The couple times that I've done it, CR1 has been better. So we just almost always just do CR1. Now, mobile home parks, it's a little bit different. You know, they're going to come in and they're paying lot rent. And so you're going to go into the Part 2 section of the rental part of the homestead property tax credit. That's the first one. And at the bottom, there are going to be 2 questions about whether it's a mobile home park. You're going to answer yes to both of those questions. What that will do is take $36 out of the annual rent or $3 a month out of the annual rent and make that pure property tax. So it gives you a richer property tax calculation than if you just took 28% of the total rent. Importantly for mobile home people, oftentimes they have a structure around their mobile home. It can be a shed, it can be an overhang for their car or their picnic table where it's on a slab and it has its own property taxes that they pay. And all you'll do there is go into the homeowner section and enter whatever the property taxes were for those adjacent structures. Okay, now Part 3 of the homestead property tax credit in the software is alternate housing facilities, and it's a whole hodgepodge of things. So in subsidized housing, it's the state has this as a category, and they want you to identify it, but it's still 23% of the rent the client paid. But the key is that you must really ask specifically in a hard way, what is it you paid? Not what the rent of the place is before they got subsidized. So the amount paid on their behalf by a government agency is not included. Service fee housing, though, is different. It pays a lower property tax, so less of the rent paid is assumed to be property tax. It makes a much smaller homestead property tax credit, or oftentimes you don't get a credit, but they're paying much lower rent too. Now there is a list that the government provides, but Dennis has been working with Julia and some of us we got this idea from another VITA site in the Kalamazoo area, where they pulled out the relevant information to the area codes that are around Washtenaw County and Wayne County, the western part of Wayne County and the northern part of Lenawee County. And we're also getting more information on service fee and tax-free, and it'll be in an Excel file. I understand it, Julia, where it's going to be much easier to search the address to see if it's on the list.
You should be able to just Control F and search. The list should be much smaller and will only include Washtenaw County. It will not have all of the states.
It's going to be a huge help. You know, as I said, we got this idea from this other clinic, and boy, a light bulb went off, and you know, all the other clinics saying, geez, what a great thing to have.
I have seen the document of the housing list, and I have you all in my heart from going through tax season with such a complicated spreadsheet.
So one of the things you got to be careful of, though, is oftentimes you have both the person is in service fee and it's subsidized. And if that's the case, you want to click service fee because you want to generate that 10%. You don't ever want to click them both. Service fee overrides if they're both service fee and subsidized. That's what that point is right there. Now, cooperative housing, we get quite a few people from cooperative housing in the Ann Arbor area. I think we have like, I don't know, 8, Julia, cooperative housing facilities?
We have more, about like 13 or so.
13, I mean, it's a pretty big number. So, you know, there'll be a letter that comes, you know, and the state is really pushing hard on cooperative housing, nursing homes, homes for the aged to provide a letter on what their share of property taxes is. We'll see if that happens, but the state in the training in Lansing this year said they're really pushing hard to get these places to do that. We're also going to be collecting letters this year. We always say we're going to do that. Somehow we never do it, but we did collect one. Here's an example. This is University Townhouses. And the person gets this letter and it says how much of their monthly, they don't call it rent, they call it carrying charge, but it's basically rent, is property taxes. Now you notice that's a lot less than 23%. But it's bigger than the service fee amount of 10%. But you take that times their carrying charge, and that's their property tax that you'll enter into TaxSlayer. They ask for what the annual property tax is in this part of the software. Now, if they were itemizing, you could also do this interest calculation, but that's really rare. The other thing, and I don't want to confuse everybody, but they do in this case provide a taxable value. There are some, well, there was one site in Ann Arbor, Scott, you're probably aware of it. In fact, Scott, I think you worked with Joe McCadden, didn't you? Scott?
Yes.
So the way Joe taught this is he wanted the taxable value entered for these cooperative housing homestead property tax credit situations. It's easy to do. You just go back up to homeowner, and the only thing you put in there is the taxable value. And then it shows up on the form. It doesn't have any impact at all on the calculation of the homestead property tax credit. So there is a way to do it, but we don't ask you to do it.
I can't remember ever doing one. Not too often if I run into co-op housing.
So special housing is that everything else. Basically, what it comes down to is, you know, once in a great while, we have to call the place up. How many square foot is the whole place? What's the square foot of the place of our client? How much of their monthly cost is actually rent as opposed to food, nursing care, and other things that are provided and so on. But hopefully there'll be a letter and we don't have to go through that. This is just a little bit more about that, how you can do that calculation. And this is more on it. You know, it can get pretty complicated. We don't get a lot of these, but you know, and the state is really trying to get these organizations to provide their tenants letters.
I had this summer, a client who lived at Silver Maples in Chelsea, and they had a letter that laid everything out very clearly. So,
Yeah, I mean, Silver Maples would be the gold standard, I'm sure.
right.
Yeah. Well, that's good, Martha. I'm glad to hear that. This is more in the letter. Yeah, we don't see a lot of this, you know, where the spouse maintained a homestead elsewhere. And oh, well, I'm sorry. Wait a minute. This is a what is this saying right here? This is an accounting aid society slide. Michigan homestead maintained elsewhere by the spouse is considered a part of the same homestead. If filing a joint return, spouses combine the THR of each and combine the property tax and statutory percentage of rent paid for each. Yeah, I guess that makes sense. Yep. We don't see it very often, if ever. And then the next one, a single person who is a permanent resident of special housing and also owns the house he or she formerly occupied may claim for credit either one. You can't do both. So this is a little bit more on property tax, you know, if it's a homeowner. It can't be the second home, it has to be the primary home. It's levied, billed, not paid. Do not include penalty and interest payments, and do not include special assessments. And we do see this in the Ypsilanti in eastern Washtenaw and western Wayne County. Sometimes we'll see some special assessment. We're supposed to take those out. This is what a property tax bill looks like. In this case, there were no special assessments. This is a whole thing on sharing abodes. And remember, people have to be on a lease, and you know, they each get 50% of the rent. It's pretty straightforward, really. The bottom part of this slide is if someone moved in with a family and they're paying their mom and dad, as an example, rent. You know, we're going to discourage that because one of the questions you might ask is, well, is there a contract? And they might say, well, yes, and we have to take their word for it. And then we'll say, well, you know, if your parents are filing a Schedule E, and I can guarantee you they're not. So in that case, we would say they're not eligible for the credit. So what does it look like in TaxSlayer? We've been through this quite extensively. You know, you go into the credits, and then the two credits are pop up right here. And remember, down on the bottom here is where those additional entries are. I didn't take a snapshot of that, but it's one of those scroll down pages. I think it's on this page, that area down there where you have to put those THR entries in. And then you come in here and you have to answer, yes, I'm eligible for the credit, homeowner, renter. These are the three sections. Remember that a homeowner, you enter the annual property tax in that section. And in cooperative housing and housing facilities, you're going to enter an annual property tax. In the renter section, you're going to enter the monthly rent. And in the rental part of part 3, you're going to enter the annual rent. So that's a little bit confusing. You got to really watch the words, and you got to go back to the form to make sure it all makes sense. This is what it looks like for the homeowner. And where it goes into that form that I showed you at the beginning of the night. There's his taxable value and the summer and winter property taxes added together. For renters, again, this is not worded correctly because these are renters down here too. You know, for most situations, the address didn't change, so you answer this first part no, but you must have the landowner's name and address. On the rent for a straight up renter, it is a monthly rent. If it changed during the year, it's okay to take the average of the 12 months and put that average in there. Or
Actually, now they have, if you go a little bit lower on that
yeah, you
page,
can split it too. You can do 5 at this rate and 7 at that rate. You can do it either way.
Yeah.
Yep. Now, if there is a mobile home, and I'll have this in a future slide, this is where you answer these 2 questions, yes. But I think I have a slide on that. And where does that information go? Well, it goes back to page 1 of the 1040 CR1, and it'll have that rent right here, the annual rent, and then 23% of that is the property tax that flows down to here. The mobile home, it's literally almost the same, except you're going to answer those 2 questions at the bottom, yes. And then on the 3rd page of the CR1, you're going to see the information flowing through on the mobile home at $500, not the $503, because $3 was taken out and added in as $36. In the front page, it goes up on the top, and then the $500 of rent times 12, 6,000 times 23%, and then they add those 2 together. Occupant of a housing facility, it's the 3rd part. Always fill out the landowner's name. In every case, you're going to do that. And then there's the service fee. If that's a yes, and then we're going to have that search capability that Julia talked about. And remember, in this case, it's the total annual rent. It's not the monthly rent. It's the total rent paid in the full year. So that's going to come back to page 3 of the CR. And there's going to be an X on service fee housing. You'll see it on there. You'll know you did it right. You'll see that the 10% factor was applied. It will come over to the front page, the first page. Only the property tax portion of it will come. It'll come in the same place it does for a homeowner, and then down to the line 13, which is the total. Back to other versions of housing facility. This is subsidized housing. So you're always going to fill out the top. Then you're going to say yes. Whoop. I'm sorry, that should be, I didn't do a very good job. That should be yes, and that should be no. Again, it's total rent paid by the taxpayer. And then that you're going to see an X for subsidized housing here. And then that's going to flow to the front page in the rental section here with the full 23%. And then co-op housing entries, you're going to enter the annual taxable value. You'll see in here that it'll say what was the taxable value of the co-op unit. Oh, that's the taxable value if you wanted to enter it. I'm sorry. That point I made earlier, you don't put anything down here because it's already been calculated and inputted back here. It looks like I'm missing a slide though, but it's there when you go into the software. Oh, here it is. Cooperative housing, yes. And then you enter which one it is here. I didn't pick one. And then you're just going to say what is the prorated share of property taxes. And most of the time there's a letter. And then on the CR, you're going to see that X over here, cooperative housing, and that number is just going to be right there. And then it comes to page 1 of the CR. And I told you how you can enter the taxable value, but that can be left blank too. And just the property tax that you entered flows in up here and here. Special situation for a homestead property tax credit is when I think, did I see something, Patrick and Julia, where we made this 75% this year, or is it still 80%? But when the rent is greater than 80%, is what the slide says, we need to generate a letter because the state will reject it. They'll say, how could you have rent that's 80% of your total household resources? Well, there's some good reasons why. And our experienced clients know what those reasons are. Here's an example. Now during the conversation, you may find out that mom and dad may be helping with the rent. Well, that's a gift, which you have to add to THR. But they may have inherited money. They may be relying on savings. They may have some significant savings that didn't show up as income. And we just have to send documents that show they're drawing down from a savings account during the calendar year. So there are a number of possible reasons why. Okay, the home heating credit, and then I think we're just about done. Again, first question is, are you eligible for the home heating credit? Well, your homestead has to be in Michigan. You have to be either own or have your name on a lease, just the same as the homestead property tax credit. You can't not live in university operated housing. You cannot be a full-time student claimed as another person's dependent. You cannot get the home heating credit if you're a resident of a licensed care facility. There are very low income limits, which we're going to cover. And the filing deadline is September 30th. So it's a little bit later than it is for everything else. There are two types of credit calculations: the standard credit, which is by way the vast majority of our clients, and then there's an alternate credit, which requires that the heating cost be greater than 11% of the total household resources. That's really high. These are the 2020 allowances. They're up from last year. I didn't put last year's down, but they are definitely up. But you can see if they're just one person, if their THR is greater than this, they're not going to get it. So, you know, a lot of times our preparers enter all the data for the home heating credit. When they look at the printout, the Michigan printout, they'll say, well, how come it didn't generate a credit? It's because the THR is above these limits. But the other point I'll make here is some of those disability scoring can up the exemptions and, you know, up the income and the standard allowance. So they're important to get those right. The alternate credit I talked about, it has to be greater than 11% of THR. And it has maximum income limits as well. This is a current year Consumers Power bill. Pretty happy with Consumers Power because they put the annual heating cost in red, very easy to see, very nice. DT didn't do such a good job. It's kind of on page 2 buried, but it's there. It's in there for I think it's December, January, February bills, I believe. November to January, I'm sorry. It says right on the top of the slide. Okay, we already said that. So if they're a part-year residents, you end up prorating the standard allowance, and the software will do that for you. if they're married filing jointly and only one spouse lives in a care facility, you do not check a box. I don't even know what that means. Anybody know what that means? Huh. I don't think it matters. So, I will tell you that, well, if the heating costs are included in someone else's name, like your landlord, and that happens a lot, they have to go through a process to actually get dollars in their pocket. So they'll receive an energy draft with it, then they have to send that back to Treasury with an explanation. Then they'll get their actual money.
Is this new?
Apparently it happens because we don't hear a lot of complaints. People get their checks.
I always would tell people that they would get a check if they didn't have an account in their name.
Well, it must happen, Martha, because I always ask Emma, and before that, Amanda, and before that, Patrick. They say we never hear people, they get their money.
But I didn't know there was this extra step of getting a draft.
This is the Accounting Aid Society slide from Detroit.
Huh.
I don't ever experience this myself, and it doesn't sound like you do either.
No, I always thought they just got a check with no questions asked, but apparently they ask questions now.
Yeah, well, this is the same thing. This happened last year. Now you have to provide the heat provider's name and the heat type code. That drop-down menu of the suppliers has been expanded. I think you guys remember last year there were some propane suppliers that weren't on there, but they've expanded it. You have to also answer all the questions in TaxSlayer about the household members, whether they're U.S. citizens or qualified aliens. So the 2020 form and instruction book are not yet published yet. So when you go to the Michigan Department of Transportation or Department of Treasury website, you won't see it. So these pictures are from 2019. When you go into the home heating credit, this is what you see. Again, that first question, are you eligible? You have to just know the rules. And then you put the county in. That's pretty straightforward. This drop-down menu is gas, electric, propane, etc. And then the names of all those suppliers are here. There's the citizenship question. Is your heating costs including your rent? Yes or no? And then what was your heat costs for that period, November 1, 2019 to October 31, 2020? I will tell you, if you leave it blank, it will generate the standard credit. You don't have to know it. We always try to get it, but in the vast majority of cases, it's going to be a standard credit. So this other part here, let's see, where is it? These other dependent things here, the only place that this ever occurs is in the rare situations you claim someone to get head of household, but you don't claim them as dependent. And we had, we had a few of those last year. It is possible. And we don't ever use the direct deposit information in the bottom here. We don't use it. So getting back to the TaxSlayer recap, we've been through this a few times. I don't need to go through it again. On the miscellaneous forms, though, if there is a deceased taxpayer, you're going to go into this area. This is from last year, where we're putting $1 in. If they only are filing Michigan taxes, we're still going to try to have them e-file federally by using that dollar trick. I think you are all familiar with that. And you put in the description, in order to e-file. Now, in 2018, they did a supplement, Michigan did, that had like 10 problems with 4 parts to each one. So it was like 40 problems. It was like a 1 ABCD, 2 ABCD, and so on. For 2019, they came out with a supplement like in August or September. way after the tax season was over. But it is there, and it has the answers, and it's really good. And I did all the problems, and they all worked in TaxSlayer, and they actually had an error on one. It's not in the ones that I'm recommending you do that I had to get. I told them they needed to fix, and they agreed. There was one they had the wrong answer. But if you could do one, it's a homestead property tax credit one for a homeowner. Number 2 is a homestead property tax credit for a renter. Number 6 is a home heating credit. And number 7 is tiered pensions. They're easy to do. You just make up Social Security numbers and addresses and so on. And you go into TaxSlayer. Now, I will tell you that there are some tricky aspects, and I'm sorry for all the words. But the reason I'm asking you to do these on number 1C, it was a 64-year-old unremarried spouse whose wife died 2 years earlier at age 66. So in the opening page of the homestead property tax credit and TaxSlayer, you score that. They ask, do you have a deceased spouse that was 66 or older when he or she died? If you miss that, the homestead property tax credit goes down from 1,263 to 751. That's $512. I mean, that's a big miss for a client like that. On problem 1D, it's an interesting one. A couple they were homeowners. They left the home on July 1, the problem says, and and moved in with their son, but they didn't sell it for 2 months till 2 months later. So in the homestead property tax credit, it's like, how many days do you put in there? Well, you put in the days they were in the house, not the days they owned it. It's the days they occupied the house, and that will generate the right answer. In problem 7, the base problem, there's interest income in the taxpayer's tier 1. I will tell you the interest amount automatically is accounted for in Michigan as a deduction for a tier 1 in TaxSlayer. There's no Michigan entry required at all. Unlike retirement income, where you do have to do some work. On 7A, this demonstrates the potential advantage of a tier 2 versus tier 1. As a tier 1, the Michigan refund is $77. As a tier 2, the refund is $600. Well over $500 more. This is because most of Mr. Earl's income is wage income, and the primary tax benefit in tier 1. Tax benefits in tier 1 are retirement income and interest, dividend, and capital gains. In tier 2, it's a $40,000 standard deduction against all income. So it shielded Mr. Earl's wage income and generated a larger refund. On problem 11, the base, this is an example of a single retiree with SSA exempt income of $25,000 who was born in 1957 and retired in 2016. Again, you go into TaxSlayer, you ask those SSA exempt, you answer those SSA exempt questions exactly as they're asked, and it will generate the correct $15,000 standard deduction. And again, this guy was born in 1957, and he's in a section that's for taxpayers born before 1953. Okay, problem 11B is the same as the base, except now he retired in 2012 versus 2016. That's a question a little deeper into the retirement section in TaxSlayer, and that generated an even bigger standard deduction of $30,000, just to answer the question. And then in 11A, the problem changes to a married couple. It's a little different than the base, with one SSA exempt income of $30,000, but still born in 1957, but retired in 2012. And again, answer all the questions, generates the right answer. It generates the right answer. So sorry for all the words on that, but doing those exercises that I recommend back here, we're not going to ask you for them, I don't think anyway. These right here, we'll just leave it up to you. Now, I will tell you though that Let me go back to stop share. In the Michigan instruction book, which I don't think I have up, in the 4884, is it 4884 or 4484? 4884. They have 10 examples in there too. And I did every one of those in TaxSlayer. They had one error, which I pointed out to them, but they all work in TaxSlayer. It's pretty good. It handles these things pretty well. You just got to know the little crazy things.
Those are pension schedule examples.
Yeah, the pension schedule, is that 4484 or
Something like that.
4884? I can't remember. But let me just go see if I can find that real quick here.
Bob, is there an answer key for the test for returning volunteers or for experienced volunteers?
The QEV?
Yes.
I got all the answers. I got 95%, and I know the one I got wrong.
Are they
Not the
published?
first one where they had all those errors on the 13614.
Is there an answer key published somewhere?
I have it. I mean, I can give it to you. It's handwritten right in front of me.
Oh, okay.
But
Thanks.
the QEV on the federal side is a killer. The qualified experience exam, qualified experience volunteer exam, QEV. But the thing that is so fantastic about it is one of the problems involves scholarship and qualified expense income. And it verifies that if the scholarship is unrestricted, you can increase the person's scholarship income all the way to the full amount of the scholarship and end up far better off by having a bigger American Opportunity Credit, by using all of the qualified expenses up to the limit of the American Opportunity Credit for that credit. Something we started to do last year, about early in the season when we learned about it, but I don't know if you know what I'm talking about. The problem confirms that you can in fact do that. I'm going to open up the Michigan instructions real quick here. Then I'm going to stop share, or no, now I want to go in here. Can you see the Michigan instruction book here? Can you guys see that?
I mean, we can see the title page from your folders.
You can't see what I'm doing right now? Hang on a sec here. Let me redo it. I probably got ahead of myself here. Screen share. Here it is. This is the instruction book. And when you go way deep in the Michigan instruction book, they have that's additions and subtractions. Way down in here, they've got a whole, it's 4884. They've got several examples of what goes into a 4884 right here. Various scenarios with the answers. And the answers are sort of like you're doing it by hand, but you're not doing it by hand. So they got that one, and you can see I confirmed as Jerry Michigan. I called him Jerry Michigan. Jerry and Beverly. So in my TaxSlayer practice lab, that's what it is. But these are, it'd be good for you. Don't do any SSA exempt ones. In this case, TaxSlayer picked the best outcome. This is one where I think one of the spouses was deceased, and whether they go tier 1 or tier 2, it'll pick the one that's the best. TaxSlayer just does it. It's really good. These are good to do. Those are good problems in their 2020 problems. That's what's good about them. The supplement is 2019, but it's pretty darn close. Things haven't changed that much, doing
And
those problems that
the
we did.
supplement is the one that,
Supplement, there's a link for it. I think Emma and Patrick or somebody sent it out yesterday or today. The supplement is, let's see. This is it right here. It's called the Taxpayer, no, that's the supplement. And it came out like in August. And the problems are like, here's problem 1. And you just enter it into tax layer. And then there'll be a A, a B, a C, a D. And the answers are provided deeper into the document. The link has been provided to you. And it's also in the resource area of United Way's website.
I looked at the resource area and I don't,
Well, she may not have put it up there yet, but I know she sent it out.
Yeah, so speaking of resources, like one of the things Julio's been doing right now is trying to get some resources updated into our website during this. We're going to be doing some more Friday and Saturday, and honestly, probably a little bit Monday. There's just a lot of things to change. And on top of this, we've run into some trouble working with all of the video files we have. So my hope is, Tuesday morning, kind of after MLK Day, a handful of more things are going to be updated, available, and we can kind of send them out.
You can find this supplement in the Michigan Department of Treasury website. It's in the professional prepare area for some reason. But the nice thing about it is it gives you all the answers. They're further way down in the, you scroll way down here and they give you the answer somewhere down here. They explain it. They explain the calculation. Of course, you'll be looking at it from, from the form standpoint. So, any other questions? It's an awful lot to take in, but most of you are familiar with it. Hopefully, it's just a refresher.
I had a comment on the service fee housing people. Most of them are not going to get the property tax credit, and a lot of them will get the heating credit. And that's
Right.
just because they're in there because they're low income. So that kind of takes them out of the property tax credit,
Right,
I believe. And then also their rent is reduced
right.
significantly. That's really the reason why.
Yeah, I
And
mean,
then-
10% versus 23%,
Yeah.
plus the rent is lower.
And they're disabled
It's going in the
often.
wrong direction, right, Scott?
Yeah, they're disabled is they're often times, so that gets them a couple exemptions on the heating credit. That gives them a higher ceiling to be under.
Yep. But I think, we did a really great job last year. We didn't have any, all after July 15th when we were all done. We had hardly any calls about errors. We had one woman call and say, where's my Michigan refund? I got my federal refund. Where's my Michigan one? So we go back and check. We had e-file federal, paper Michigan, but we never, when we sent her the documents out, we didn't say, sign this and mail it. She didn't want that. She wanted e-file. And we missed it. Quality reviewer missed it. Preparer missed it. We have now put that in our second review check tool that Patrick Hellman is working on with the U of M engineering student as a second check when there's a discrepancy between federal and state on whether it's e-file, paper, and so on. Other than that, I mean, things, went really well. I think we did a great job. We were very accurate.
I thought you did a good job, Bob, covering a lot of ground tonight.
It's a lot. It's too many slides, Scott.
It is too
I don't
many.
want to use those. I don't want to use those Accounting Aid Society slides as a base anymore. There's too much in them.
But every other thorough Michigan training has taken a lot longer.
Well, in that meeting today, everybody struggles with Michigan all around the state. All around the state.
could I add one other subtraction that we might be on the lookout for, although I think it's going to come up very rarely, and that is the 529 contributions. On the housing forms that we give clients, they're asked that question on every one. Total contributions made in 2020 to a Michigan 529 education savings program. And you can take that amount as a subtraction on the subtraction page.
Up to $10,000.
Yeah, so I've
I
never
wish you
seen,
had that on the intake. You're working on the intake, aren't you?
well, it's on the intake forms for all the different on all the different housing sheets. That question is asked. So one of these days, someone's going to put a number there, and we need to know where to put it in tax layer. So it's right there on the subtractions page near the top.
Yeah, that's a good one. You know, we didn't cover, like, you know, we're going to have people with income in another state, nurses traveling around to help out with COVID.
Oh, yeah.
You know, that's a subtraction, the income they had in another state. We didn't go through that, but you know, once we get the Michigan 4012 plus the Michigan instruction book, plus you can call anybody. You know, and the good thing about doing this virtually is if you're not sure, you call me, call Scott, call Martha, call
Question?
Julie is an expert now. She knows it all. Just call her.
Great.
I didn't take the federal class. I'm assuming it's going to be somewhere on
It'll be a repeat
in a video somewhere or that I can pull down. But one question is there any type of support coming for all those people who work from home with higher utility bills, grocery bills, water bills?
I don't know. The only thing in this phone call was on a day the IRS was on there. And we talked about two things. One was, you know, in tax layer, the people have to know how much stimulus they got in the first round and the second round. And they really should bring in the forms that they got, but you know, they're not, geez, you know, so that it can be reconciled. The other thing that we talked about was the earned income tax credit look back. So in the latest bill that was passed, if your earned income was more favorable in 2019 to generate a higher credit than it was in 2020, your earned income went down because of the pandemic, you get to pick the higher one to generate a higher.
Interesting.
But the IRS said we are pulling our hair out trying to figure out how to do this.
How to do that.
Yeah. And there's nothing in tax layer right now. If you go to the IRS website, you'll see a lot of stuff on it. She said just every day go to the IRS website to see what the latest is on that. But, you know, if a person had lower earned income but got a lot of unemployment compensation, that will wipe away that look back, she said. Well, of course it should. You know, because they got the unemployment compensation, but
there's a lot of people who didn't get unemployment compensation because did not. Yeah,
that's right, and that's why they put the provision in.
Is it possible people are getting assistance for their utility bills and their rent from service organizations or from the county, and that would be part of total household resources, maybe?
I don't know. It should be, you know, I think by the logic of total household resources, it should be, but, and there's a lot of that going on out there, helping people pay their bills beyond just the stimulus checks. But, you know.
I don't even know on the stimulus checks, what kind of documentation. I didn't get one. My son got one, and the only thing he got was deposited into his account.
Yeah, no documentation.
Nothing actually came in the mail.
Everybody was supposed to get, there's a different form number. It's right in tax layer when you first open up a new return. I forget what the form numbers are, but you either, if it was a direct deposit, it got mailed to you as a receipt, or if you got a check, it was part of the mailing of the check. But you know, our clients,
I got the money, but not the forms.
Yeah.
you know, well, there you go.
He didn't get the forms.
Yeah.
It just showed up in his bank account. That was it.
So I'm a little concerned that, you know, but, you know, so when you think about it though, I mean, for a single person the phase out started at $75,000, right?
Yep.
So our break point is well below 75,000. So you have to assume that our clients got the full amount on the first one and the second one. The only place there'll be an adjustment in the tax return is if they had an additional dependent that came to them as part of the 2020 return, either through a birth or an adoption or a who knows what.
And that stimulus counts as income?
Nope.
Oh, okay.
But what the 2020 return is doing is reconciling. So when they did the stimulus check, the first one, they used the 2019 tax record.
Yes.
But 2002, it was a 2020 stimulus. So now when you do your 2020 return, it can only go up. So let's say your 2019 return was $80,000 for a single person. So you got a little bit phased out. Your 2020 return is $10,000. You should get that difference. So you can only get more from the reconciliation, not less.
Okay, I guess I'm gonna have to see that because I'm not understanding that.
Yeah, well, it's just crazy. I mean, I think, it's good policy. They're only gonna help you if, like, you had a child or adopted a child or whatever.
So,
But there's a place in tax layer for us to put the stimulus money.
Yes.
Okay.
and also, even if the client does not have a statement to show us, they will be able to mark whether they receive or they did not receive and how much they receive of the stimulus check in the intake form. So, and whatever they say there, if, seems believable, then they will be the ones to sign off that they did get that money or didn't get that money. So there will be information in the intake form, and you will be able to input it into tax layer as well.
Okay.
So the IRS person today said if they're wrong, we know it's right. That's what she said. So if they say I didn't get it and they really got it, they're not going to get it a second time. So they're really just looking for the changed situations that are legitimate where they can get more.
Okay.
And that's usually dependents,
It could be.
For us, it's dependents. For higher income people that were, above 150,000 for married filing jointly and above 75,000 single, where your income went way down in 2020, you'll get more. You'll get a supplement to the original stimulus check.
Mm-hmm. Okay.
But
the second one
that's not going to be our client base.
Yeah, you're right.
Yeah.
The second one hasn't come out yet, has it?
Yeah, it's been deposited in a lot of people's accounts.
Well, I don't think my son got his. Let me check.
I do not think that has been completely delivered. Just like the first one, it's a process. Unfortunately, that takes a little too long, I think. But it's a lot.
I think it has to be out by the 15th tomorrow.
Yeah.
Yeah, they had there was a problem where they had routing numbers and account numbers in temporary accounts at TurboTax, and I think even H&R Block did too, that weren't the real account numbers and routing numbers of the client because they were going to draw out their share. And then they send them a separate check to their real account number and routing number that the IRS didn't have.
So I do have a short list of very common situations in which someone may need to request for the EIP rebate. This is also in one of our slides. We're making the slides available very soon, I promise. So a very common situation is a taxpayer who was a dependent in 2019, but not a dependent in 2020. Also a taxpayer whose spouse does not have a valid social security number. The first stimulus check did not allow those who, let's say one spouse has a social security, the other spouse has an ITIN. Neither of them were eligible. They are now, the spouse with the social security number is eligible. So because they weren't able to get it back then, they're able to get it now. Also, those who did not file previous tax returns in time, and as well, those who did not get the full amount, as well as very often depend when they didn't get the extra $500 for dependents early on.
You know, Julia, somebody's gonna have to do a little training on the HSA. 2 slides.
We will definitely be sharing more information about that too. HSA is one of my weaknesses.
Yeah, HSA, and then city taxes. You know, we could just use
Did
that video
HSA
that
pull?
guy in Lansing did, but you know, I mean, I didn't cover city taxes tonight. We did do quite a few city tax returns last year. I don't know. What do you think, Martha? 15, 20?
Oh, I don't know the total, but I remember seeing a few.
Yeah. And you know, there's some tricky things in city taxes. You know, there's a
Did
real
any
good
of the-
video that this guy at the Lansing United Way did. You know, that's not bad. We could just.
I watched
I know
it,
that. I think we have that link on the website already, but
Yeah, he went into situations that were unusual, complicated. So I
Right.
don't, I think a simpler presentation would be more helpful to us.
so are you going to do that, Martha?
Yeah.
Since you've been doing city taxes in Detroit for a long time,
No, those are
your
just
own.
my own. Yeah, I still have to learn a lot about them.
Yeah. I think if we get a city tax return, I think we're going to have to like spin that off to somebody that's got some experience with it.
Right.
We don't get a lot, but you know, we get a few.
I've done quite a few.
You have?
Well, Scott, there you go. Hey, Scott,
There
would
you
you do like 4 slides for us on city taxes?
All right.
That'd be great. It's just